There is a solution for that is sponsored by VARC Solutions. VARC Solutions helps small businesses succeed by delivering expert QuickBooks bookkeeping, consulting, quick-base development, and integrated solutions. If you own a small to medium-sized business that uses QuickBooks or QuickBase, the experts at VARC Solutions can help. In business since 1999, with people who care and the knowledge and experience to solve your toughest problems. Visit varcsolutions.com for all your QuickBooks needs. Welcome back to another edition of There's a Solution for That, where we help small businesses succeed by discussing challenging business problems and best-in-class solutions. All right, welcome everybody. We have a great podcast episode for you today, and we have a great guest talking about a very common problem that a lot of small businesses and medium business owners face when trying to buy or sell a business, among other things, and that is valuing your business or valuing the business that you're trying to purchase. And we've got an expert in that area to really help us talk about that problem and how that's actually being solved. And so Ryan Hutchins at Peak Business Valuation. Ryan, why don't you introduce yourself and just kind of share with the audience just a little bit about you?
Yeah, hey Brad. So my name is Ryan Hutchins, Peak Business Valuation. I'm also a business owner of a multi-location bakery, pizza chain. I own a plumbing company and a striping company. So I love everything small business. And my team and I, we value close to 20 to 30 companies a week.
Wow.
For individuals buying and selling businesses all across the country.
That's awesome. And so you're a glutton for punishment. How many businesses?
So bakery, pizza, plumbing, striping. So total of 4 plus Peak, so 5.
Wow. That's fascinating. Well, I'm not going to say you're a typical business owner, but I will say that out of all the business owners that I've met throughout my career, you're not necessarily uncommon. There's business owners that get into all sorts of businesses, and somehow, shape, or form, they don't always relate. So congratulations on all that. Maybe let's just get started and really tell me, in terms of the business valuation business, how did you get started in that?
Yeah, so I got started. So like my background, I studied finance at BYU and then accounting at Santa Clara. Started my career as a tax accountant. After I got my CPA, like most individuals who work at a big four accounting firm, they leave and do something else. I was no exception. So I left and joined a business valuation firm because my buddy was at the company and enjoyed working on Saturdays. And I didn't believe it, so I thought I would give it a try. So that's how I got started in business valuation. And I've been doing it for over 9 years now. I started Peak about 6 years ago and have loved every second of building a company, but also helping others understand kind of their business and why it's valuable or not valuable.
Well, you must be doing something right to be doing 20 to 30 of those a week. That's impressive, and obviously you've got a team supporting you. So great job on building that business. That's fantastic. Um, so one of the maybe this is a not so obvious question, but when somebody's looking to buy or sell a business, obviously a business valuation is a very common component, but is that the only reason? Like, what are maybe some of the reasons that might not be so obvious why somebody might need a business valuation?
Yeah, so let's look at it from the perspective of a business owner. So a business owner, let's say divorce is a big one because one of the primary assets in divorce, if there's a small business involved, is that business and determining how to appropriately split and who's buying who out. So we do a lot of divorce valuation work as well as partnership disputes and partnership buyouts where lawyers get involved. Another key area is for gift and estate tax planning. So if you're wanting to gift some equity in your business to family members, or transfer some of your equity into an estate or a trust, then that's where we come into play, and that's pretty much mandated because the IRS needs to understand how fair market value is determined so they can figure out how they're going to tax you and get their money. Um, so those are the most common ways that we deal with. Like valuation gets very detailed, and there's many different service lines. So like stock option issuance for tech companies, as well as when you buy a business that's of larger size, there's a valuation exercise that we do called a purchase price allocation, and
Mm,
it's primarily a financial reporting requirement. So, and it really is just creating, like, if you sell a business for 45 million, the buyer needs to look at that 45 million and be able to allocate that 45 million to each asset acquired so that the accounting firm can appropriately start. This is the beginning balance sheet as of day one.
right. And of course, being the owner of a bookkeeping and accounting firm, I totally get that side of it, right? Because then you've got depreciation of that value over a certain number of years, which is important for taxes and deductions, on your net income and all that kind of good stuff at tax year. So, um, one of the things I love about this podcast is that I get to learn cool stuff like this. I mean, again, never would have occurred to me that like divorce is like one of the more common reasons, or estate valuations. So thanks for exposing our audience to that possible reason why somebody might reach out to somebody like you. Um, Question, I mean, I've dabbled in valuations. I've actually had a few done for different businesses that we've bought or sold, and so, but one of the things that's always been elusive to me is like, what is the difference between what I guess people refer to as a certified business valuation versus maybe a non-certified business valuation? Is there a difference, and when would you use one versus the other? And so I'm just kind of curious what your thoughts are on that.
Yeah, so I that terminology never comes up with us. So it really comes down to like we're trained in business valuation and have certifications. So everything that we do in relation to valuation is certified. Whereas you have business brokers and other individuals online that will give you a free valuation, but it's really, and that would be more so considered non-certified because ultimately it's more software telling you what potential value is. So it's more user input instead of expertise kind of
Right.
going through and assessing value. So that's kind of the primary difference, and one that I talk about quite often on LinkedIn. Because for us to value a company, it generally takes anywhere from 15 to 40 hours, depending on how large a company is and the type of industry it works in. Whereas you could get a free valuation through a software in 20 minutes just by entering some numbers.
Right.
And so that's probably the clear distinction between certified, non-certified.
Yeah. Okay. So in layman's terms, like if I was going to kind of parrot back what I heard, it's almost like if you want a real business valuation, you call someone like you, right, to do the full comprehensive, soup to nuts, A to Z,
Yep.
review of everything. Whereas, like, if, maybe if I've got a CFO, I might be able to go to a CFO and say, hey, here's my financial statements. What do you think? Right. And it might just be more like a back of the napkin. Okay, well, based on this net income times this multiplier, I think it's probably this. Is that kind of maybe the difference?
Yeah, that's the difference. What One of the other big pieces of it is as part of our certification and the work that we do, we're held liable for the opinion we make. Whereas if it's not certified, like there's no risk to the individual kind of stating an opinion, whether accurate or inaccurate. And so depending on the scenario, it's always good to understand kind of why you need to understand the value. and where you're getting the information from, just because there's a lot of misleading uh, like sources out there from a free like online valuation perspective. So
Yeah, no, no, I totally get it. And what's interesting to me is, especially when you talk about like is it certified or not certified? That's the language that I've heard just in conversations with various banks or lenders that, we may be approaching to say, hey, can we get funding for this purchase? And what I've heard back is like, well, you need a certified business valuation. And so that lingo just kind of sort of stuck in my head. But also interestingly enough, and this relates to one of the questions that I wanted to explore with you is like, um, if you're a business owner and you're looking to sell your business, should you kind of go out and get your own valuation, or do you really work with the bank to do that? Because I know when we had approached a bank, they said, well, you can go get your own valuation, but we can't use it. So I'm just kind of curious about how that part of that industry where it revolves around business financing and funding, where I can or can't bring my own sort of valuation to the table. What's your kind of knowledge and experience on that?
yeah, so let's look at it from the perspective of a buyer. So we have a lot of buyers call us on a weekly basis that are inquiring about what's the value of the business that they're going to acquire. And I always ask if they're going SBA. And the reason why I ask that is ultimately I want to educate them and let them know that as part of the standard operating procedures for the SBA loan program, like the bank at a certain point is required to get a business valuation, more so to help the bank understand that what they're lending on is factual and that it truly appraises for the amount they're lending on. So, but from a buyer's perspective, like a lot of buyers want to go that route because one, they're going to pay the bank and the bank's going to pay us to do the valuation. And so, like, I, it ends the calls really abruptly. But with buyers, the reason why sometimes getting a business valuation through a bank isn't great is ultimately the client to the valuation firm is the bank. So the bank's the one that engaged us. So therefore, the report is their property. And then there's some banks that won't issue that report to the buyer. And in other cases, they do issue the report to the buyer. But if they were to call us, we could not answer any questions because they weren't our client. And so, from the perspective of business valuation, like as a buyer, the bank's always pretty much going to order the business valuation. But if you're in the early stages, like you just signed the LOI and you're looking to and then start your due diligence, like if a business valuation is ordered up front, and let's say the value comes in under the proposed purchase price, like that enables the buyer at that point to negotiate or try to talk down the purchase price from the seller. Or the seller says, nope, I don't care what they say. I'm not going to do it. And that pops up a red flag. And so rather than kind of going through a month or 2 months of underwriting for a loan before finding out that it doesn't appraise, like it's much easier and more cost effective on the front end to get it. So that's one of the main reasons why buyers typically get a business valuation. Whereas a seller has a different story. So a seller doesn't really care whether or not a bank's going to order the valuation. More so, they care that is is what I'm looking to get out of my business even plausible, or am I just too too high in the sky and need to be brought down to earth? So that's why
Yeah.
sellers will reach out to us because ultimately sellers, well, I'll go back. So a lot of free online valuation tools are tied to business brokers or insurance brokers or agents. And the reason why they do that is they use it as a lead magnet
Mm,
to get a seller through the door so that they can help sell that business and get an 8 to 12% commission.
right.
So, like, there's an incentive for them. And so, when a broker lists a business, more likely than not, the business is always going to be priced higher than what its actual fair market value is. And so a lot of sellers prior to working with the broker will approach us, or even after working with the broker for 6 months, they'll approach us and be like, hey, we've had a lot of offers on the table, but they've all fallen through the cracks. Like, why? Could you help me understand like what is wrong with my business? And we go through the valuation exercise and the seller sees, oh, why is the broker trying to sell my business for X? When from a logical perspective, it should be worth Y. And so that's a harder conversation. Most sellers like to hear that their business is worth more. But from a
Sure.
logic standpoint and removing emotion, that's that's where we come into play because we're very objective and unbiased towards the situation.
Yeah, and you also want I think again just kind of reflecting some of the things you're talking about. Um, follow the money, right? It's like if somebody's offering you a free valuation, they're making money somehow, right?
Yep,
You
yep,
know,
yeah, correct.
so there's an angle somewhere. They're not just doing it out of the goodness of their heart. And if they get paid based on a percentage of the total sale, yeah, they're incentivized to value it higher. Fascinating. And then it sounds like, just in general, I mean, it sounds like the advice is, get your own representation. Just like if I was, buying a business, I don't necessarily want to use the seller's attorney, right? And might not even be able
Exactly.
to, but you want to always have your own representation so that you've got somebody fighting for you, whether you're the buyer or the seller, right? It just makes sense. So
Correct. Yep, yep.
that's fascinating. And well, and it leads to one of the other questions that I had. You talked about, a buyer, I'm sorry, a seller that maybe has a number in their head, like I want 10 million for this business or 20 million for this business, and that may or may not be realistic, but that's the number, right? That's what they have in their head that they want. Um, and then the buyer on the other side is doing the same things. I think this might be worth, 8 million or 12 million versus 10 or 20. And so I'm curious, if you're doing that many valuations a week and a year, you've got to have some pretty amazing or interesting stories, maybe where somebody came in saying, I think my business is worth 5 million and you do the numbers and you're like, no, I mean, I think this is worth a lot more, or vice versa, a tenth of what you thought it would be. Can you share maybe just from a buyer or seller perspective some of those big wins where somebody was very happy at the end of the evaluation process?
Yeah, so most of my stories are in relation to business brokers. So one more recent story is a bank engaged us to do the business valuation. We did the valuation, presented it to the bank. The bank then took it and was like, okay, this is coming in lower. Why is it coming in lower? And so we explained to them, and then they passed it to the buyer. And most often buyers are kind of relieved or happy. But then somehow the broker got a hold of it and wanted a phone call with us. And we love talking to brokers because brokers like talking about how they have this this valuation experience. And so this particular case, like this is why when we're valuing a company, we use multiple valuation methods to derive value because reliance on one valuation method can lead to some skewed results. So in this particular case, the business broker relied on multiples across about 10 different industry classification codes. And that's like a red flag number one. is if you can't find a particular industry that this company fits in, like how are you supposed to select comparable transactions that are kind of pure play, kind of like Subway. Subway's really easy. You know exactly what you're looking for when you're looking at comps, but there's some businesses that cross so many different like industries that it's very hard to pinpoint and say, oh, this is like multiples that should be used and transactions that should be observed. And so then you got an approach called the income approach, where you're looking at the underlying cash flow relative to risk. And it's a very internalized valuation approach to assess value. And in most instances, is more accurate when you can't find transactions for the company. So for that reason, like we were on an hour-long call with this broker, explained to them our valuation approaches, and ultimately the broker conceded and agreed with our work. And so the buyer was able to renegotiate that. So that's one. Um, in most instances, when we work with buyers separately, if we come in under and find out that the purchase price was X, we talk to the buyer on how they're going to approach the seller and try to negotiate for a better price. And that's more fun to deal with. It's very like we don't always hear the results of how it went. Ultimately, as you know, buying a business takes months to close. And so we're just involved primarily on the business valuation side. But a lot of buyers, when we come in under, they will use our work to help negotiate a lower price. And more often than not, they're able to negotiate to that lower price in order to buy the business because they're using logic and objective data to have that discussion with the seller rather than basing it off emotion and kind of, oh, this is what I think. So, yeah, does that
Yeah.
help kind of paint
Yeah.
a picture?
Yeah, it does. And I really, really like the objective part because, whether you're the buyer or seller, you're going to have emotions. You're going to have, um, um, you know, you might feel slighted if the offer comes in super, super low, or you might feel taken advantage of if the offer comes in super, super high. And so we can't always control how we feel about things, but you're more concerned with, hey, here's multiple methods evaluating valuing this business, and so the net effect of that is a broad range or a narrow range that hopefully does take some of the emotion out of it, so that both sides can be dealing with just real numbers. I really really like that and appreciate that, it's a little frustrating that you don't ever hear or you don't commonly hear like the end result of it, because I know that when we've gone through acquisition, buying, selling, those types of things, I always send thank you cards to the people that helped along the way, because it's like, hey lender, you really did a great job on this transaction and really want to say thank you and I appreciate your work. And same thing with valuation companies, brokers, people that are doing the M&A. All those people are really contributing at a high level to making sure a transaction does get done well and closes. So um, I would say thank you if you did a good job for me. I can tell you that much. You
Well,
would know that things went well.
yeah, you're a very unique individual if you do that.
Well,
After doing about so over the last 9 years, I've worked on close to about 7,000 business valuations, and I don't recall ever receiving a thank you card, or if I have, it's probably less than five.
wow.
So, but yeah, like ultimately, like the one thing that's always fascinating. So having bought businesses, like after my first business, I learned kind of like when I started to Peak, I learned that I'm a horrible bookkeeper. So therefore I hired a bookkeeper. And same with an accountant, even though I was a tax accountant. When it comes to due diligence, like on my first business, I thought I could do it with my partners, and we didn't hire outside help besides an attorney. However, knowing what I know now, all the other businesses that I've bought, I've reached out and hired business valuation firms and other professionals that can assist with due diligence, because ultimately money spent will either result in a transaction taking place, or it'll result in, hey, you didn't go into debt for $3 million. So therefore the 20 grand that you spent on a quality of earnings and a business valuation was well worth it, because now you don't have to service debt
Right.
and deal with potential headaches.
Yeah, absolutely. Paying for expertise. I forget who I ran into that said this, or I might have heard it on another podcast, but basically, uh, paying people what they're worth and being willing to pay experts for their expertise will ultimately save you a lot of time and a lot of money down the line. So, totally get and appreciate what you're saying. Let me ask it just another kind of just a basic question. I would call this maybe a business valuation 101 type of question. You touched on it a little bit already, but maybe just for like super clarity, what are maybe some of those more common business valuation methods? Just kind of like the 50,000 foot view overview of what are some of the common valuation methods that somebody can be considering.
Yeah, so within business valuation and real estate appraisals are very similar. We follow the same standards. So one of the most common ones that is generally observed on our end is looking at the underlying assets. So take, for instance, laundromats. Laundromats are a very hot topic in the acquisition space. Most laundromats are only worth what their equipment is worth,
Hmm.
just because the cash flow isn't strong enough to support a higher value than their fixed assets. And so the asset approach really looks at kind of what is the value, fair market value of the underlying assets, and then you subtract out the liabilities that are going to be owed to result in value. So that's one way. And the only way to assess fixed asset values through an equipment appraisal. The other way that everyone pretty much knows is the market approach, where you're looking at private transactions or public companies and looking at what multiples did these companies transact at. And what a lot of people don't understand is the databases that store all these private transactions. They are databases created by individuals like lawyers, attorneys, SBA lenders, and valuation firms. And their data is not always inputted correctly. And plus, a transaction is based off of, like, you have the value of the business plus the terms associated with the actual agreement. And so the resulting purchase price can vary. So, like the market approach, where you look at multiples of revenue, EBITDA, and seller's discretionary earnings, has to be observed with great attention. So that's why we always look at other approaches, because the income approach that I mentioned earlier in the conversation is one of the best tools to use when assessing value, because ultimately if you're looking at a mom and pop pizza franchise that revenue's been growing at 3%, margins are around 15% pretty much year over year, like we can look at that and assess kind of, okay, this is what cash flow is for the business and what one would expect if they were to buy this business. And here is a measurement of risk associated with achieving that cash flow. So very steady businesses have less risk associated with achieving cash flow, whereas companies that are growing at 20 to 50% or more, or they're on the decline, have a much higher risk inherent with kind of achieving that cash flow. And so the income approach is one of our favorite ways to assess value, just because it's internal and you can do risk assessment and it's like really dig into the actual qualitative and operations of the business to see how does this impact value. Does it increase or decrease value, or like one of the key components of risk is customer concentration. When you're looking at multiples, you can't factor in customer concentration as easily. But the income approach, if you have a customer that represents, like we worked with a company recently, one customer represented 80% of revenue.
Mm.
And it's like, how sticky is that customer? Is that customer married to the seller, or is the relationship truly just with the company? And so understanding kind of the like those different risk factors, like customers, management, financial, competition, geography, economics, like there's many, many more, but ultimately the income approach is our favorite out of the three to utilize when assessing value.
Well, let me ask a follow-up question because I mean you really alluded to something there that may be below the surface that I'm not sure if everybody got. I maybe barely picked this up myself, which is this is not just about the numbers. Um, somebody can say, "Hey, here's my financial statements," but um, it sounds like the story behind the numbers is also part of the process. And maybe is that true? Is that a true statement? Or how much do you dig into the story behind the numbers to understand it versus just looking at raw financials?
Oh, the story is key. So, and it's pretty amazing. So the average seller out there doesn't know their numbers well, and the average buyer out there doesn't know how to read or understand financials. And so when people engage us, like it is working to understand the story and the narrative about why the company is operating the way it is, understanding why certain expenses have increased over the last couple of years and are they expected to increase. So like you look at any restaurant, the two largest expenses, labor and food costs. Well, one, labor is more expensive today than it was 3 years ago, and food costs as a result of inflation is higher than it was 3 years ago. And so understanding why certain expenses and revenue are moving in the direction they are truly helps us understand how we should be assessing the company. So financial performance and digging into financial analysis is where we spend the most time in our valuation. And we perform what's called industry analysis, where we compare this company's financials to that of the industry. And we use a company called BizMiner, which is probably one of the, it's not known as well, but it's one of the coolest software tools out there, where you're able to, this tool taps into the IRS through an API and is able to aggregate 5 years of balance sheets and P&Ls to show this is what the average company is doing. And we could get as granular as plumbing company doing 2 to 5 million in revenue in Utah. And we can see there's 200 companies and this is the average balance sheet and profit and loss statement. It's,
Wow. That that's
it's,
that's that's also like in real estate, I guess, where when somebody's doing comps, right? With similar houses, that's basically the same concept. You've got comps of different businesses within specific industries or um, company business type codes, etc.
yep, yeah, correct. And so, like, what's great about looking at industry data is we could kind of compare and contrast and see how this company is doing relative to the industry as a whole in that state. And every seller has the primary objective of showing as little profit as possible on their tax returns. Whereas the industry data, because it's pulled from the IRS, you're also looking at companies that have the primary incentive to show as little taxable income as possible. So it's a good apples to apples comparison from that standpoint. And we're actually in the process of building out a tool that utilizes BizMiner, but makes it much more prettier than just an Excel spreadsheet, but provides all these graphs and different interpretations. So, because ultimately that's the one area that most people like from our business valuation is the industry analysis. Because if you've never looked at a business before in the plumbing space, it helps paint a better picture for a buyer to see, as well as a seller to see how the company is doing and is it on pace or is there something askew where this company's financial ratios for net working capital are off relative to industry comparables.
Wow, that's incredibly interesting to me. I mean, because yeah, it's like if you're not doing deals all the time, you might do one deal every 5 to 10 to 15 years, and that's not a lot of experience to apply and learn expertise and acquire knowledge and expertise to do deals well. So, I mean, just that value alone has got to be worth a lot. I mean, people call me and they're like, "Hey, I'm looking to, sell my bookkeeping practice or I want to buy a practice and, should I is it a multiple of sales? Is it a more multiple of net income or EBITDA? All those different types of things. But, you're going to have businesses that are standouts and really are standouts apart from the crowd or average, but then, being able to know what those averages are uh, can really, give you some perspective that you might otherwise not have.
Yep, yep, correct.
Fascinating. Well, so maybe just a couple really super basic questions that I would imagine maybe our audience would like to know from your perspective, and just ballparks here. What's a range for a cost of a business valuation? How long do these things take? I mean, are we talking a week, a month, 3 months? It's like just what do you see typically, or what do you see on average in terms of cost and time?
Yeah, so for us right now, here, I'll preface this by saying it's October of 2024, uh, just for future posterity.
Hmm.
But ultimately, from a pricing standpoint, our average fees for any business between like our lowest right now is doing 10,000 in sales. It's a divorce. All the way up to about 80 million. Um, like average fee, base fee is 2,600 per business valuation. And we have fees that go up to about 16, 17,000 right now, just depending on the size of the company from a revenue perspective, the number of like entities that roll up into that company. This is the
Right,
80 million.
right.
And then what industry does this company cover? So like look at a Subway franchise, like there are so many Subway franchises transacting on a weekly basis versus looking at a machine shop that has a specialty within their CNC. It's all custom work. Like those are far and few between. And so like there's some industries are more straightforward than others just due to the amount of volume that we see and the amount of data that's available to us.
And approximate, like, how long does it take to do one of
Yeah,
these?
yeah. So it generally takes about 2 to 3 weeks to do the valuation work from a transactional side, so buying or selling a business. When it's divorce, like divorce or partnership disputes, where it's more kind of contentious and there's lawyers involved, like it's all about dotting the I's, crossing the T's, like multiple times. And so it generally takes us about 3 to 4 weeks to do that work.
That's still, honestly, it's not a lot of time. I mean, I mean, in the grand scheme of things, that's nothing, right? It's, if you have to spend, 3, 4 weeks getting a valuation done, and it saves you 6 months of time not doing a deal that you might have otherwise done, and then the potential to have a 5, 10, 15 year payout on a loan, that month is not that long.
No, it's not. And one of the interesting things, especially if you're selling a company, like all the information that we request initially and after we go through our research from the seller, like all of that is going to help the seller better communicate with the buyer who's going to ask the same question. And so they already have the responses prepared and the documents prepared. Whereas from a buyer's perspective, like the buyer ultimately, we don't want to talk to the seller if a buyer engages us, just because one, it looks better that the buyer's making these requests from the seller. It shows the seller that the buyer's very interested in wanting to understand and do their due diligence. But also, if a seller talks to us, the seller feels inclined to ask for the valuation report because they're the ones that truly helped us kind of get to the finish line. But from
Right.
a buyer's perspective, like the information that we request, like it's a good sign that the deal is not great if the seller takes their time to address questions or to address questions with like half-hearted answers or answers that result in more questions or ambiguity. And so it's important, like it, yeah, we work with a lot of buyers where we essentially end the engagement and not finish the business valuation and charge them the full fee because we weren't ever able to get all the information. And so it just threw up red flags left and right. And the buyer just withdrew from the LOI because they couldn't get clear responses for a
Wow.
simple exercise as a business valuation.
Yeah. It's like what's my income? Why do you need to know that?
Yep. Oh, it's always great when when you get tax returns and you're like, okay, you reported a loss of 200,000, and then you see their company prepared for that same year, and you're like, how is your profit 500,000? Like, what did you spend 700,000 on?
Right. Well, you raise an interesting point, and it leads to a question that I've got, which I forgot to ask earlier, and that's okay. So as a business, right, you're generating income, you've got expenses, and so you've got your net income, and part of your job is to make that number as low as possible for taxes, and of course that's what you're reporting on your tax return. But at the same time, you want to show that your business is making as much money as possible when you're trying to sell it. So how does that work, right? How do you play both sides of the fence, or is it just different perspectives on the same fence? I mean, how does that typically work?
Yeah. So when it comes to kind of playing the tax game, like it really comes down to documentation. So for instance, the plumbing company that I bought in 2021, the seller incurred around 20 to 25,000 a year in expenses related to travel. And the seller told us that essentially it was related to vacation expenses for one big trip with the family every single year. And we're like, okay, where's the proof that shows us that this truly happened? And ultimately, like that's when the seller provides like credit card statements or just some documentation to show that yes, indeed, this expense was more so personal. If we're not provided like strong supporting documentation, it's very difficult for us to say yes, this is a personal expense, and so therefore we need to add back that cash flow. Um, so it really gets very confusing with most people.
It,
So
it,
if you're
is that pretty typical though? So like in other words,
uh,
the tax return might have some personal stuff in there, whereas if you're selling it, you want to add back the stuff that was personal to have a maybe a more accurate reflection of the actual income.
yeah, yeah, that's correct. That happens quite often. And it's up to us to figure out kind of what they have documentation for that we can add back
Right.
versus what is just a lost cause and essentially they already ate their cake by evading taxes.
Right.
the first go around. And so if they can't support it, the second go around, they don't get any contribution. So one of the primary business models that has it's not necessarily an add back, but when you think of nail salons or liquor stores, there's a lot of cash receipts that are not reported on a tax return. And with those, a lot of sellers will try to incorporate uh, those cash receipts, but ultimately, like a bank is going to dismiss it just because they order IRS transcripts. And so if the tax transcript of what is actually filed with the IRS and the tax returns show that that revenue really isn't there, then they won't even consider it. And from a business valuation standpoint, we don't consider cash receipts either, just because that is more evidence of tax evasion than if you ran like your Honda Pilot through your tax returns as a personal vehicle.
Right. Got it. Got it. Okay. I mean, it's again, it is fascinating stuff. One of the questions that I'm thinking, like, what would somebody be asking if they were pinging me via chat? Hey, make sure you ask this question. Is, let's say maybe I'm not ready to put my business up in the market today. Maybe I've got a plan. I think 3 years from now, 5 years from now, when I get closer to retirement age, that's when I really want to start considering this. But it seems to me that waiting until you're ready to sell is maybe not the right time to start getting the information together that you would need for a proper valuation. So I'm curious, from your perspective, first off, just maybe what are some of those, two, three, four things that you always require whenever you do a valuation, and when should that preparation start if you are the seller, to make sure that that information is good, solid, accurate, all that stuff.
Yeah, so the primary documents like that we first ask for are 2 to 5 years of tax returns, and then kind of company prepared profit and loss and balance sheet as of a date like September 30th, 2024. And ultimately, when it comes to preparation, if you're looking to sell and you're wanting to sell in the next 2 to 5 years, like no one really knows when they're going to sell, but the easiest place to start is making sure your financials are clean and that they're easily legible and people can follow, and there's not too many questions that are going to be asked. And so, like, if they're not working with a bookkeeper that's doing their books on a monthly basis, like, that is the best place to start, because having a bookkeeper that's your accountant that really compiles the financials just for tax purposes is just going to make transacting the company that much more difficult. And so working with a monthly bookkeeper is the best thing someone can do. And at least a year or 2 years before actually transacting, making sure that those personal expenses are very minimal or non-existent, just because the fewer add backs or adjustments that have to be made to the financials, the easier it is for a bank and a buyer to look at what's happening, and they have a greater sense of ease that this is a great business, because there's no, like, our largest add back that we've seen with the company is $1 million in expenses related to family salaries. And it's like, okay, how are we gonna like justify this? Like
Right.
it's much more easier to have very limited adjustments, and it makes the whole process of underwriting for an SBA loan or any type of loan as well as selling the company that much more easier, because like if someone orders a quality of earnings and does a deep dive in the financials, they're not going to see a lot of red flags or have
Yeah.
really detailed questions. So that's financials is the best place to start for anybody. So
Okay.
sorry, that was like points one, two, three, and four.
No, no, that's totally awesome, and it really makes me reflect on, what's the goal, right? So like when we work with businesses on their bookkeeping or anything else, and I talk with business owners like you, sounds like all the time, and that's, what's your goal, right? Because if your goal is to grow a business and then hand it off to your family, that's a whole different thing compared to I'm trying to grow a business that and increase the value over time to eventually sell it. In one respect, I might be um, really, again, trying more from a tax planning perspective. I want that number to be low as possible. But if you know that you're planning to sell at some point, you want it. It might be worth paying more in taxes to get a higher valuation because you haven't, been, making the net income look less than it really is or could be for the business. Do I have that about approximately right?
Oh, 100%. Like it is paying taxes is just a consequence of making money. And so if you have to pay taxes for 2 years, like ultimately just look at it from a math equation. Like for every dollar that you make, let's say you pay 40% in taxes. And so really your take home is 60 cents. But if you were to play, let's show as little taxable income as possible. And when it comes to cash flow adjustments, like instead of that dollar being there, let's say it's now 50 cents, and we add back like another 20 cents, so now we're at 70 cents. Like you're, you just eliminated 30% upside that if you applied that to a multiple that you're transacting at, that's going to be a much bigger number than the actual tax savings that were recognized. And so
Yep.
it's much better to have a bigger exit. Like I learned, so having been a CPA, I'm no longer a CPA, but having been one, like all my businesses that I own and operate, like we don't run really any personal expenses through them just because one, the standard of ethics that I had to uphold myself to with the CPA license. But two, if someone were to come by and want to buy the business, like I want to be ready. Like,
Right.
because you never know when someone wants to buy your business. So like for instance, the bakery and the multi-location pizza chain, like we also owned a catering business and someone came about and wanted to buy the catering business. And so like the financials, everything was clean and in order. And the transaction took place over 4 months. And it's like, oh, we weren't looking to sell, but an opportunity came up and we were
Yep.
prepared. Like you never it, like being a Boy Scout, the motto is be prepared.
Be prepared.
Like, yeah, ultimately it's much more easier to be prepared because if you're prepared, that means you're taking action to ensure that you also have systems and processes in place. And so, like, you're working on the business and preparing the business rather than the business kind of running you.
Right.
And you're kind of running around with your head cut off because you think you're the only one that can actually do the work.
Right.
Like, being prepared, setting up those systems, having the financials in order, like, you can transact your business so much quicker if there's little room for questions because everything is transparent and
Yeah.
well addressed.
Yeah, great advice. In fact, we're almost out of time, so I want to just wrap up with two kind of closing questions. Number one, just beyond a question that I've got on my list, but more just like from your experience, you've done a lot of these valuations, and you've worked obviously with tons and tons of small, medium-sized companies, owners. What would be your one piece of advice, that if somebody was thinking about selling their business at some point, right, in the future, like what would you say, here's the most important piece of advice that you could give? And then kind of like the part B of this question, if somebody wanted to get a hold of you to learn more about the services you guys provide, how would they go about doing that?
So the number one piece of advice that I give to anyone, whether they're buying or selling a business, is to work with someone that's unaffiliated with the company. So kind of like you mentioned earlier, an attorney, like a buyer and seller should never have the same attorney. And so from that perspective, like an attorney acts as a fiduciary on your behalf, kind of like a bookkeeper, a good tax accountant, someone that can assess and understand financials, or a business valuation firm. Like hiring professionals who are great at their craft can save someone, like it costs money, but at the same time, it saves money or makes them more money if they're selling the business. And so from that perspective, like the number one piece of advice, because I could, like, if you want to work with us, great. But if you want to work with another valuation firm, like I couldn't be more happy, just because you are a buyer or a seller or anyone is going out of their way to seek advice from someone else that is objective and not emotionally attached to a potential transaction, to provide that opinion that brings logic into the equation. So, but if people do want to work with us, they can always reach me. My email is Ryan at peak, PEAK, businessvaluation.com. They could also go to our website, which is peakbusinessvaluation.com, or they can call my direct line because I'm always happy to jump on a call. And that number is 435-359-2684.
Awesome. Thanks, Ryan. Again, I mean, this has been incredibly enlightening. Even the little that I thought I knew about the topic, you've raised my level of knowledge in this so that I'm uh, more knowledgeable and wiser for the next time that we go through a transaction, whether it's on the buy or sell side. So really appreciate your time. Really appreciate you sharing your expertise, and I hope the audience that's listening in on this got some value out of it as well. So again, thanks so much. And for the rest of you that are listening, hope you enjoyed the episode, the podcast here, and we'll look forward to talking to you again very soon.
Awesome. Thanks, Brad.
Thanks, Ryan. Appreciate it. There is a Solution for That is produced by VARC Solutions. This episode was produced by Ashley White and Aaron Riley. You can subscribe to this podcast on Apple Podcasts or Spotify. Watch the video version on youtube.com/There's a Solution for That. Or visit varcsolutions.com/podcast, where you'll find our entire podcast archive, as well as show notes, links to solution providers, and complete transcripts of every episode. If you love the podcast, please leave a review with your comments.